Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Tuesday, June 18th, and we are in the middle of the summer where it's about 110 degrees here in Palm Desert, California. We're going to talk about three topics that are moving markets we're paying attention to, so you should be as well. So thanks for joining us. First of all, we're going to talk about the U.S. consumer. We're also going to discuss four trends to track moving forward. Markets are paying attention as we are. And then tomorrow, even though it's a holiday, our office will be closed. We are still working all the time. I'll be in the Palm Springs studio for Fox Business with Liz Clayman. So tune in tomorrow. I think it's the closing bell, so just before 1 o'clock Pacific Standard Time. Let's get right to the three trends to track right now. Number one, we're always watching earnings. Earnings are still hanging in there, and they're continuing to grind higher and show positive, solid growth, even a double-digit earnings growth on majority for the S&P 500. And the back half is still looking strong as well if we look at the S&P 500. So growth in earnings, not only this year, but the forward earnings growth is still there. So companies, large companies, are still making money, and that's why markets are continuing to grind higher with that positive backdrop. Another positive backdrop is the U.S. consumer right now seems to be hanging in there by all looks of all the data that's coming out. And then the growth of the GDP, will we slow down later this summer? We can discuss that. And if so, if the slowing down in the GDP gives us maybe two recessionary quarters where we have negative growth on the GDP back to back, with also tight or from labor market going from tightening to softening, how does that set up? Do we actually have a recession later in the year? And I know that's not even a consensus view right now. That's an outlier view. But we always have to take a look at the other side, the other aspect of the markets, and pay attention to sort of what's coming down the pike. Right now, where clearly it's the tipping point. We're normalizing, growth is slowing, but it's not tanking right now, which is good. And inflation is coming down clearly by all the inflationary readings that we're seeing. So there are some documents here that we're going to go through. We're ready for the global easing. Keep in mind right now, the Federal Reserve has yet to ease their policy, right? They've changed their rhetoric, their language. They said they're looking for data dependent. They're waiting for something. We believe it's going to be September is probably their first move, and maybe the day after the election in November will be their second move, given the data. And we believe the data will start supporting their view of now at the easing cycle, that tipping point as I discussed. That being said, might be the last of the party if you look at it globally. Globally, over a third of the central banks right now have actually lowered interest rates and eased. And so what we're seeing is that this is a rising sort of the central banks are cutting rates all across the globe. And right now we're up to 30%. And so we're going to see that trend continue because we want to basically become less restrictive. Because inflationary data is coming in favorable. Now, keep in mind that it is a 2-year lag effect from when the first rate hike by the Federal Reserve is felt to actually implementation and infecting the economy by slowing the consumer. So as of right now, it's been well over 2 years. And historically speaking, normally you see from the last rate hike to the first cut an average of 7 months. And that's been a lot longer than that right now, too. So this is anything but normal. But again, post-COVID, post-stimulus, we don't expect it to be. But this is where, historically speaking, we see that trend continue. Now, inflation scare is largely over, especially in the emerging markets. You're seeing places like China, Germany, and all across the globe. Basically, China's down here at a 0% growth rate right now. But then if you look at the developed markets and the emerging markets, both of us, one thing you can't debate is the trend. The trend is, obviously coming down. The trajectory of the trend is sort of the debatable consensus that everyone's having right now. Now, the consensus is very bullish on the consumer. The consumer is still hanging in there. And again, since the Fed starts talking about rate cuts and the actual easing of financial conditions, that takes quite some time to do that. And that's an impact that we're going to see play out later on the consumer. And if it does, the recession, we believe, potentially could be underpriced. in what everyone's sort of thinking and doing right now. Again, we watch earnings again after this next quarter earnings season. We have to see how it plays out, but we also have to see how the unemployment data comes in, and if it continues to sort of go in the way the Fed wants it to. They want to, tighten the labor market a little bit. Or ease it, if you will, so they have more supply than demand, but it's still a tight labor market. But that being said, there's potential forecast for a negative back half of the year for the GDP, but it's less scary than you might actually think, because there's still behind it some reacceleration in the economy, not only built in by more stimulus spending, if you will, by the governments in 2025, but again, we'll see what earnings are doing. But we just want to see the PCE inflation data continue to trend in the right direction. Growth is trending slower, and so we'll see how this all plays out. But at this moment in time, there's lag effects of the Federal Reserve is going to take hold. The Fed is at a tipping point, going from not debating the direction of inflation, now just debating the rate of change of growth and seeing what they want to do in their next move and how quickly they want to do it. So all eyes will be, again, on the Fed, but keep in mind, number one thing we're going to watch are the earnings, and earnings are still in there quite strong, especially for corporate America. So that's our updates for today. Tune in tomorrow. If you don't, we'll send it out anyway later this week. But thanks for watching, and we'll catch you again next time.